Okay, now the question came up, where does this number come from? There are three methods that are used. The first method is straight line depreciation. That method is the only of the three that is always acceptable. Okay? Does that make it easy? You can always use it. There is the only fixed asset you can't use straight line for is what? Land. Because you can't depreciate land, period. But if you can depreciate, you can use straight line. In fact, there are some assets, such as real estate, that is the only method you can use. Okay? For buildings, for those types of things. So leasehold improvements, only method you can use. Okay? So straight line is going to be the most common by far. Now, straight line is very simple. This is the simplest of all methods. It's taking the original cost and dividing it by a fixed period of time, and then each period taking its proportionate portion of that time. So to look at this very simply, if we buy a car, let's say, for $20,000, and we choose to depreciate that over a 5-year period, we're simply going to take each year 1/5, and we're going to increase accumulated depreciation by 1/5. So what's 1/5 of $20,000? $4,000. So the first year, we're going to depreciate that car by $4,000. So in the original fixed asset account, it's going to say $20,000 is the car. Okay, that was the original cost. And accumulated depreciation at the end of year one will be $4,000. So what's the book value? $16,000. Okay. Now next year, we'll have had it for another year. We'll have depreciated by another 1/5. So we're going to increase accumulated amortization another $4,000, right? So what's the balance in accumulated depreciation? $8,000. What's the book value? $12,000. Everyone with me? Next year, another $4,000. Accumulated depreciation is how much? $12,000. And book value is $8,000. Next year, $16,000 with book value of $4,000. And finally, after 5 years, the original cost is still shown at $20,000, right? What's the accumulated depreciation at? $20,000. What's the book value? 0. Very simple, isn't it? Okay. Now, one other thing I wanted to point out is typically we don't wait until the end of the year to depreciate the whole asset. We will divide that annual depreciation by 12. And then each month, take 1/12 of that $4,000 and increase it. So over 12 months, we will have accumulated $4,000. Okay? If you look back one page at page number 217, at the bottom of that page, you will see a table that covers 99% of the assets that you'll run into out there. It includes computers and other electronic equipment, 5 years. Trucks and automobiles, 5 years. That's been long-standing for several years, over a decade. That's been 5 years. Office furniture and fixtures, 7 years. There is some discussion of changing that to 5 years, okay, in some cases. But right now it's 7 years. Manufacturing equipment, 7 years. Now, in parentheses, you might want to write heavy equipment. Okay, a lot of earth-moving equipment and so forth fits into that category. Leasehold improvements. Do you remember what leasehold improvements are? You only have those when what's happening? When you're leasing that space, right? And they are improvements that you made at your own cost to a building you don't own, but you're leasing, okay? And they're attached as opposed to unattached. Good. So anyway, those are leasehold improvements. It says the duration of the lease. Now, I want to tell you something. This is different than the tax code is. That's all right. It's all right in certain exceptions that you can do it differently because the tax code, in my opinion, is all messed up on this particular area, okay? And they got this really strange number. But for accounting purposes, it's the duration of the lease, whatever remains on the lease. So if you've got 30 months left on the lease when you make that improvement, you're going to take 1/30th of it each month and depreciate it, increase it by 1/30th. Okay? Then we get down to residential buildings. Here's an interesting one, 27 and a half years. Do you find that a rather peculiar number?
Yes.
You know, it gives the impression, doesn't it, that someone has done a pretty amazing study to determine the life of a residential building. A lot of effort appears to have gone in this, doesn't it? Back in the 80s, it used to be 15 years, okay? In 1986, there was a big push to try to increase taxes to the business. The business owner would pay more taxes, okay? And there were some lobbyists that were in there saying, if we stretch out this depreciation period, then each month or each year, the businesses will have a smaller depreciation deduction, won't they? And that means higher taxes, right? So if we go to 40 years, it's going to be better. Businesses will pay more taxes because businesses depreciate. Individuals don't depreciate their so it's only going to impact businesses. Great way to get businesses to pay a bigger tax. So let's go to 40 years instead of just 15. What's the number between 40 and 15? 27 and a half. That's compromise is what that was. That's how that number came to be. Isn't that interesting? Okay. So it's not a scientifically derived number. It's 27 and a half years is the tax code. That's what we use for them. Okay, and commercial buildings are 39 years. That was our most recent change. Up until early 90s, it was 31 and a half. It's now 39. Okay? If you'll look at page number 217 up at the top, you'll notice at the end of the paragraph it says, more detailed information can be found in IRS Publications 334, Publication 534, and Publication 946. Okay? This table at the bottom of that page does not cover all assets. Give you an example. Where would Carnival equipment fall? It doesn't show, does it? But is Carnival equipment a fixed asset? Okay. It could be either way. Could be. They might buy it, they might lease it. But if they buy it, what's the depreciation period? You could guess, and that might be a good guess, right? But if you'll look in Publication 946, we don't have it here because we can't get a whole bunch of them for everybody. You can request it. You can see it through the internet, okay? You can request it through the internet. You can call over the phone, and the phone number is shown there. 1-800-TAX-FORM is a phone number, and you can call them and ask for it, and it will be mailed to your home. There's no charge for it. But Publication 946 has an exhaustive list of different type of fixed assets. And you'll be able to find Carnival equipment on there, okay? You'll find 2-year-old race horses. You know, race horses are a fixed asset, aren't they? Okay? Dairy cattle, you'll find them on there. So it just has, it gets very specific to types of assets and tells you how many years. So it's a good publication to have in your library for that other 1% of fixed assets that maybe doesn't fall under that table at the bottom of the page, okay? I'll tell you, I very rarely have to refer to 946 except for when I get calls from students. Okay? Most often when you're talking with businesses, it's all going to fit underneath that table, and so you'll see that rarely will you have to go into that 946, but it's a good thing to have if you do need it.